Hello and welcome to the 2021 Gates Stock Pitch Competition. My name is Seth Tilton.
My name is Jack Carter.
And we will be pitching Dollar General as a buy recommendation. And now I'll turn over to Jack for the overview.
Awesome, thanks Seth. Dollar General was founded in 1939 by J.L. Turner and launched their IPO in 1968. They are one of the largest discount realtors spanning across 46 states with a net annual revenue of roughly $34 billion. They have four main revenue segments, consumables being their largest, which makes up roughly 75% of sales. Next is seasonal products such as Halloween costumes and Christmas decoration, which makes up 12% of sales. This is followed by home products, which accounts for 6.5% of total sales. It includes items such as clocks, curtains, and picture frames. Lastly, we have apparel, which makes up 4.6% of sales, and this is items such as t-shirts and baby clothes. Next, we'll discuss a little bit about Dollar General's management. Their management is comprised of Todd Vasos, the CEO, and 9 other officers. Their board of directors is made up of 8 individuals with various backgrounds that make the governance of Dollar General very diverse. The board is led by Chairman Michael Colbert, and all the board members are compensated with a base salary plus stock options. Now, a little bit more information on Mr. Vasos. Mr. Vasos was promoted internally from COO to CEO in 2015. And since then, the management team and himself have implemented several key initiatives that have accelerated the Dollar General's growth and increased their competitive advantages. The first initiative has been to open 1,000 new storefronts a year. And this has helped Dollar General widen their location moat and increase their revenue significantly. Another initiative the management team is focused on is to increase their relevancy with customers. To do this, they have increased their cooler space per store, which allows them to carry a greater variety of perishable products. The next initiative they have focused on is their DG Fresh initiative, which aims to increase their self-reliance by bringing distribution of frozen and fresh products in-house. Lastly, they have recently introduced a new storefront called Pop Shelf to the market. Pop Shelf stores have a smaller selection of products that sell for a larger profit margin than the traditional Dollar General store. We're going to follow this up with talking about some of their competitive advantages. We feel that Dollar General has 3 main competitive advantages, with location being their strongest. They currently operate approximately 17,000 stores throughout the United States, and they target towns of 20,000 people or less. By targeting these smaller towns, Dollar General exploits a huge untapped market. According to Kevin Walker, Senior Investor Relations Director at Dollar General has identified 12,000 new markets to expand into. Kevin further explains that there's a Dollar General within 5 miles of 75% of the United States population. This gives Dollar General a significant convenience factor over their competition. Combine that with their low-cost business structure, and Dollar General has created a well-fortified business. They keep their operating costs low by leasing their buildings and relying on a strong self-distribution network. Also, part of Dollar General's low-cost business plan is to be a low-cost provider for their customers. They are able to provide roughly a 20 to 40% discount compared to local mom and pop shops. They can provide this discount because of their strong bargaining power that they have with their suppliers. This is further backed up in an interview with Naomi Sales, the Investor Relations Director at Procter & Gamble, stating that the Dollar General is one of their top 10 full portfolio clients. Lastly, we want to address their brand moat. Dollar General further protects themselves from competition by branding themselves as a fill-in style instead of a fill-up style such as Walmart, meaning they design their stores for more frequent and shorter trips. Dollar General stores also have a smaller standardized layout, making it much easier to get in and out of the store quickly. Both Dollar General's fill-up branding style and their small store footprint couples really nicely with their location moat, further strengthening their convenience factor for the consumer. Now I'm going to let Seth take this away with some of the ratios that we looked at.
Thank you, Jack. Yeah, so there were 7 key ratios that we identified that display Dollar General's financial position. The first ratio we would like to talk about is return on equity. We found Dollar General's return on equity to be 54% higher compared to the market average. Dollar General also has a slightly better return on assets compared to the market average. Beating the market on both an ROE and an ROA basis is a difficult task that highlights Dollar General's ability to effectively manage their assets and their debts. Dollar General also beats the market on an operating and a profit margin basis. This shows their ability to generate higher returns than their competitors, which makes sense because of their location moat that allows them to charge more for products due to the convenience factor. Additionally, Dollar General's current ratio is 1.21, whereas the market average is 1.09. Combine this with a Z-score of 3.4, and Dollar General is at very low risk of defaulting. However, Dollar General is lagging in one area, inventory turnover. At first, this raised some red flags as we were concerned that Dollar General was having trouble selling products. However, Todd Bezos addressed the issue in the earnings announcement call. He stated the lower inventory turnover was largely due to the increase in inconsistency in demand during COVID-19 that made their inventory on hand much greater, which took longer to turn it all over. Lastly, their days accounts payable ratio is in line with the market average, displaying their ability to utilize money on hand for as long as they can. Next, we want to talk about valuation and how we came up with the target price for Dollar General. We use 3 valuation models: a discounted cash flow of the firm, of equity, and a relative valuation model. One of our key assumptions when creating our discount model is a 12-year sustainable competitive advantage time horizon. Our next assumption was Dollar General's growth rate, which we declined linearly from 16% to the constant growth rate of 2.5%. We also applied a return on capital in a bell curve fashion, starting at 16%, increasing to 17%, and then decreasing downwards towards the WACC. After running the free cash flow of equity model, we determined a target price of 203. We also ran a free cash flow model of the firm, which represents the firm as a whole, including the debt and the claims on that debt. This model gave us a price of 213. Lastly, we used a relative valuation model to determine the price relative to the discount retail market. We noticed that Dollar General's price was low relative to their earnings based on the industry average and based on earnings growth relative to the market average. Lastly, we used a price to sales ratio to show that Dollar General was priced higher than their competition when it comes to sales generated. However, we do not find this concerning since they have a higher operating and a profit margin, which allows them to trail in sales compared to some of their competitors. Overall, the relative valuation model helped us determine that the price range of 203 to 213 is accurate and supports our buy recommendation. Next, I'll elaborate on our primary research and how we gained insight on Dollar General. We began our research by reading their 2019 and 2020 10K, which led us to believe that this was a great company. We then decided to reach out to store managers to gain a better understanding of Dollar General's culture and the problems faced at the front lines. From our conversations with store managers, we learned that Dollar General has a family-like culture and that they have each other's backs. We also learned that one of the current problems at the store level is inventory shortages. This was touched on by Todd in the earnings announcement call, stating that the issue was with transporting the goods to the stores and not an actual inventory shortage problem. After talking with the store managers, we wanted to get a feel for why customers shop at Dollar General. The consensus from customers in small towns and larger cities was that they shop at Dollar General due to the convenience factor and because they have cheaper prices relative to other stores. From there, we scheduled an interview with Kevin Walker, the Senior Director of Investor Relations, where we gained a lot of valuable insight, such as the 12,000 potential new store locations and the key initiatives set forth by the management team. A few days after our interview, Jack and I listened to the Q4 earnings announcement. This turned out to be very informative as Todd touched on analyst concerns with inventory. This led us to dig deeper and reach out to Procter & Gamble, one of Dollar General's largest suppliers. We spoke with Naomi Sales, Procter & Gamble's Investor Relations Director, who further backed Todd's claim, stating that Dollar General did not suffer inventory shortages during COVID, but rather had transportation issues, much like the rest of the discount retailers in 2020. And now I'll turn it over to Jack for the conclusion.
Awesome, thanks, Seth. To conclude, Dollar General is a buy recommendation with a target price between 203 and 213 that will likely prove to be lucrative in the long run. We feel that they have the right management in place to continue to strive with those key initiatives that we talked about, and they beat the market on almost all of our key metrics that we compared to the industry average. Whether you're a small town farmer looking for a quick snack or a Wall Street investor, Dollar General is a safe and reliable option for you. To conclude our presentation, we want to leave you with a quote that we really feel sums up why Dollar General is a good company and kind of some of that tenaciousness that they have to continue to strive and keep moving forward and grow. This is a quote from Kevin when we had our interview with him. And he said, even though we were a mature company, we were still in growth mode, both in sales and attitude. Thank you.
Thank you.